If you're watching this, you already know what an order block is. You can mark one in 3 seconds. That's not the problem. The problem is the one that failed. It looked exactly like the one that worked. Same displacement, same clean imbalance, same textbook zone. One paid you. The other took your stop, then went precisely where you said it would, without you. So stop treating the order block as the answer. An order block isn't a signal, it's a bill. Someone with real size, committed capital inside that candle and couldn't finish the job because price ran away before the position was complete. What's left behind is unfinished business, and price comes back to settle it. Which changes the question. Not, is this a valid order block? Almost all of them are. But is this debt still owed? And am I standing in the right place to collect it? That's today. What an order block really represents, how to market where the decision was actually made, and 5 conditions that separate the zones that still owe you something from the ones the market quietly settled without you. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let's start underneath the definition. An order block is an area where a significant volume of buy or sell orders entered the market, very likely institutional. When price returns, we expect those participants to act again, and that reaction is the trade. So yes, an order block is a supply or demand zone, but not every supply or demand zone earns the name. A zone is just a place where price turned. An order block is a place where price turned because somebody couldn't get filled. That's a much stronger claim, and it needs evidence. The evidence is imbalance. When serious pressure hits the book, price doesn't move politely from level to level. It tears through and leaves a gap where almost no two-sided trading happened. Imbalance, inefficiency, fair value gap. 3 names for the same footprint. That footprint is your proof that size was involved, rather than your hope that it was. And it's also the reason price comes back. The move that created the gap left orders unfilled. The position was never completed at the price the buyer wanted. Price returns into the inefficiency to finish what was started. That is the debt. So the working rule is simple. A supply or demand zone that produced a fair value gap is a candidate. One that didn't, isn't. Which is why the fair value gap is the first thing we mark on any chart, before the zones, before anything else. It isn't confirmation, it's the entry requirement. Now, where exactly does the zone go? Mark the candle immediately before the fair value gap. Not the big expansion candle, the one that came just before it. That candle is where the decision was taken. The expansion is only the consequence of that decision. If price comes back to that area, that's where the same participants have a reason to act again. So, to be precise, order blocks are supply and demand zones, filtered. We keep only the ones that produced a strong move and left an inefficiency behind, because those are the only ones where the story of unfinished size actually holds up. The color of the candle is irrelevant, and this catches more experienced traders than it should. In a bullish setup, your order block candle can be green, red, or a doji. What it looks like doesn't matter. What matters is that it is the candle that created the gap. One more detail, and it changes outcomes. Sometimes price drives a wick through liquidity just before the displacement. When that happens, include the wick in your zone. That wick is where the move genuinely began. It's the sweep that made the expansion possible, and cutting it off leaves you with a zone that's tidy on the chart and wrong in practice. Your stop belongs below that wick, not below the body. Now a professional grade filter. And this is where the psychology starts to bite. An order block that sweeps liquidity on its way in is a completely different animal from one that doesn't. Liquidity is simply where other people's stops and pending orders are resting. Underneath a run of equal lows, you can be reasonably confident that a pool of stop losses has piled up, longs protecting themselves in the same obvious place, at the same obvious level. Mark that as a liquidity area. If price breaks below it, takes those stops, and only then builds your demand zone, the quality of that zone rises significantly. Institutions cannot buy size into a thin market. They need someone to sell to them, and stopped-out longs are the most dependable sellers available. The same logic applies on the return. If price collects liquidity before it enters your order block, the probability of that zone working improves. Because that's the sequence real moves are built on. Liquidity first, direction second. The uncomfortable part is what that says about your own orders. If your stop is sitting beneath an obvious low, you aren't a victim of manipulation. You're the fuel. The trader who moves that stop somewhere less predictable and the trader who waits for that pool to be taken before entering are making the same decision from two different sides of the same chart. Order blocks can form at the start of an impulsive move or in the middle of one, and they come in every size. If yours is small, give the stop a little more room than the zone suggests. Price rarely turns exactly at an edge you drew, and being right about the level while being wrong by 2 pips costs you the entire trade. If the zone is large, you have 2 options. Enter around the middle for a better risk-to-reward ratio, or drop to a lower time frame and let price show you rejection before you commit. Both are defensible. What isn't defensible is entering at the far edge of a wide zone and then calling the stop out a bad setup. So that's the anatomy. Now let's talk about why a perfectly marked order block still fails, because the 5 conditions that follow are, in practice, 5 causes of death. Condition 1, direction. An order block that agrees with the prevailing trend and one that fights it are not the same trade, even when they look identical. Counter-trend zones get run over because the flow you're standing in front of has no interest in how clean your imbalance was. So establish direction first, then hunt for zones inside it. Take the time frame above the one you trade and ask whether it's still printing higher highs and higher lows, or the opposite. If that isn't obvious in a couple of seconds, you don't have a bias yet, and any zone you take is a coin flip with extra steps. This sounds obvious, and it gets violated constantly, because a counter-trend order block is emotionally attractive. A big move from a precise level, exactly the story we enjoy telling ourselves. Trading with the trend feels late and unremarkable by comparison. That feeling is not information. Condition 2, freshness. Recently formed order blocks outperform older ones, and the reason isn't mystical. The debt expires. Sentiment shifts, participants change their positioning, and the reason those orders existed stops applying. Waiting weeks for price to return to a zone you found last month is usually waiting on a payment from someone who has already left the building. And freshness isn't really measured in days, it's measured in structure. A zone stays fresh for as long as the structural move that created it is still intact. The moment price breaks the swing that move was built on, the zone doesn't get older, it gets canceled. Look at the eurodollar on the 1-hour chart. Inside this downtrend, notice how many times price builds a fresh order block, rejects it cleanly, and continues lower. The zones work because they're current. Now this second example, 2 order blocks. The first formed and was rejected shortly afterwards, exactly as intended. But before price ever returns to the second one, market structure and sentiment have already shifted. The zone is technically still there. Practically, it's a monument, not an opportunity. And underneath that sits a real trap. An old order block on your chart feels valuable because you did the work of finding it. That's ownership bias, and it's why traders defend stale levels for weeks, protecting a decision instead of evaluating a setup. Condition 3, market structure. Structure and order blocks aren't 2 separate subjects. Structure is what decides whether your zone ever gets paid. Sometimes it invalidates the zone completely. Sometimes it makes it far more probable. 3 patterns you need to recognize. Pattern 1. An unmitigated gap behind you. Here's a valid order block with a clean imbalance. Waiting for the pullback and buying it looks like a solid plan. But look to the left. There's another fair value gap and another order block sitting just below the one you marked. When that's the case, price very often makes the deeper retracement, fills that lower inefficiency first, and only then continues higher. In that sequence, your zone isn't a reversal point at all. It's a liquidity target on the way to the real one. You get filled, you get stopped, and then the market makes exactly the move you predicted. So when a fresh gap and order block sit directly behind the zone you're watching, stand down. Being right about direction and wrong about which zone pays is the most expensive kind of correct there is. Pattern 2. An order block resting on liquidity. Sometimes your zone forms directly on top of an obvious pool of stops. The order block itself is valid, which is precisely what makes this one dangerous. But before the market can go where it intends, it usually reaches down and takes what's underneath first. If that liquidity sits below your zone, it will very likely be collected before any reversal, and your stop is part of the collection. A valid order block sitting on obvious liquidity isn't a high-quality setup, it's a well-drawn trap. Pattern 3. The sweep before the pullback. This is the inverse, and it's the one you want. Price takes liquidity, retraces into the order block, rejects it, and continues. Once sell-side liquidity has been cleared, there's nothing left to reach for in that direction, and the next objective becomes the buy-side pool above. The zone isn't merely valid. The market has already paid for the right to use it. That also hands you a target before you even enter. The equal highs or the obvious resting liquidity above is where that move is trying to go. One caveat that outweighs any pattern: even a high-quality order block fails. A losing trade is not proof that your read was wrong. The best strategies available give you a modest edge, not certainty, and the trader who rebuilds his entire model after 2 losses is destroying the only thing that made it work in the first place: repetition. Condition 4. Volatility and spread. Winning setups cluster where participation is real. The market is thinnest at the edges of the week: Monday, while positioning is still forming, and Friday, as it unwinds. And the highest probability opportunities tend to sit in the middle of the week, when volume and volatility are genuinely present. The same applies inside the day. Pairs like the euro-dollar deserve the London and New York sessions. Outside those hours, price can touch every zone you drew and produce nothing, simply because there isn't enough momentum behind it to travel. A perfect setup in a dead market is not a perfect setup. Then there's spread, which quietly dismantles good analysis. Price often reacts to an order block within a handful of pips. On a widespread instrument, your entry never triggers, or it triggers at a price that ruins the risk to reward you planned, and you watch a correct read pay somebody else. And it's worth being precise about what a spread actually is, because it's the one cost that never shows up as a cost. Every pair quotes you 2 prices, one to buy and one to sell, and the gap between them is charged the moment you open. So every trade you take starts slightly negative before price has moved at all. On a deep liquid major, that gap is a fraction of a pip. On a thin instrument, or on a major in dead hours, it can be dozens of times wider. We went through all of that properly in our Forex Foundation course: spread, liquidity, slippage, and why the same pair costs you more at different hours, in the lesson, Why Do Spreads and Liquidity Matter to Me? The session side of it is in Why is the London session such a big deal? I'll leave the cards up here, so go and watch those if this part is new to you. And that second one matters to us for a reason beyond cost. The Asian range sits there untouched all night, and London routinely takes one side of it out in the first couple of hours, very often as a fake, before the real move travels the other way. That is a liquidity sweep on a schedule. If you've been waiting for a zone that takes liquidity before it forms, that window is where you'll find it most reliably. So trade low spread instruments in liquid sessions and stop donating an edge you worked to build. Condition 5. Confirmation on the lower time frame. This is the one that changes most traders' results, and it's the hardest to adopt because it means giving up the fantasy of the perfect limit order. Instead of parking an order inside the zone and hoping, wait for price to arrive, then drop down a time frame and make the market prove something. You're looking for rejection, evidence that the zone is being defended rather than absorbed. The strongest confirmation is a shift in market structure, price breaking a protected high on that lower time frame. That tells you momentum has genuinely turned, not merely that price touched a rectangle you drew. From there, wait for a lower time frame order block to form and enter from that. You get a tighter zone, a smaller stop, and a larger reward for the same idea, improving your probability and your risk to reward at the same time. Strong rejection candles, a liquidity sweep inside the zone, or a fresh fair value gap forming off it all count as additional reasons for the higher time frame zone to work. Keep the time frames 1 or 2 steps apart. A 4-hour order block confirms well on the 15 or the 5 minute. A 1-hour zone confirms on the 5 or the 1 minute. A daily zone confirms on the hourly or the 15. Go further down than that and you're not confirming anything. You're staring at noise and calling it evidence. And that's the whole framework. Direction, freshness, structure, session, confirmation. 5 ways of asking one question. Is this debt still owed? And am I standing in the right place to collect it? No setup works every time, and you shouldn't want one that does. Your job isn't to be right. It's to keep taking the trades where the market still owes something, to walk away from the ones where it doesn't, and to repeat that long enough for the probabilities to do the work they were always going to do, and to repeat that long enough for the probabilities to do the work they were always going to do. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.